With interest rates increasing and probably going to increase for the next couple of months, according to the RBA, what are some quick and easy fixes you can make to your current loan structure to be able to go and pay it off quicker, so pay off debt faster? And if you're interested in knowing what my strategy looks like when it comes to debt, then definitely keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now at the moment, we've seen where the interest rates are. The RBA is going crazy with increase after increase after increase. Now we're starting to see a lot of economies around the world starting to go into a recession. And as I mentioned previously on this channel, we are just 1 quarter away from actually entering a technical recession per capita. We've already recorded 1 quarter of negative growth when it comes to per capita, and should we see another negative quarter, then we will enter a technical recession here in Australia per capita. It's different to the technical recession that people are using, but the main thing you need to take away from that is that consumer confidence is low. We've got consumer spending falling, retail spending falling, business confidence is also falling, and suddenly we're starting to see the economy slow down. When the economy starts slowing down, and naturally it would when you've increased rates so quickly, is that you will start seeing the flow-on effects into unemployment. Right now, unemployment's not really affected, but we will see a combination of unemployment, and then obviously having a lot of migrants come into the country is definitely going to change up a few things here in Australia. Now, when it comes to paying off debt faster, yes, you could just go out there and say, hey, look,
every time I've got some extra cash, I'm just going to put it into my loan and pay it off quicker.
But if you had an actual strategy to reduce your debt quicker, you'd actually get there and be more effective than if you were just doing it whenever, wherever. Because if you don't have a plan, you plan to fail. And that's become fairly evident over the last couple of years. If you sat on the sidelines thinking, I'm going to invest, and you never actually got the chance to invest because you didn't have structured plans in place, it means that you fall further behind. So you might be going, hey, I can just pay off a little bit extra this month because I have some extra cash left over. That's great. It's better than doing nothing. But chances are you'll be lenient on yourself the next month and the month after that and the month after that, and suddenly you're not paying off extra at all. So here are just a couple of quick things to look at, and I wanted to break it down with actual numbers so that you can see the actual difference something like this could make for you. So most commonly people are paying a monthly repayment, but if you just switch that from monthly to fortnightly or weekly, then it could make a massive difference. And what we'll see here is in the calculator, we've put the loan amount of $750, an interest rate of 6%, and a loan term of 30 years. And what you'll find is that if you made a monthly repayment, it would be about $4,496, and your total interest over the life of the loan will be $868,786. Now, if you went to fortnightly, it should be roughly about half, and that would then be $2,248. But now the total interest drops to $682,696. So an interest saving of about $186,000. And then once you go into weekly, the difference between weekly and fortnightly is not so great. You're saving only a couple of $100 there. I think that's more of a nuisance, especially if you're getting paid fortnightly. If you get paid weekly, then yes, you could go down that path and just pay a weekly repayment, and that's stock standard for you. But if you're getting paid fortnightly and you're actually only paying monthly, it means that you're making 1 repayment, which is 12 times a year. But if you were to go fortnightly, that's twice as many. Now you're making 24 payments, and we know interest is calculated daily. So as that balance reduces more frequently, you should in effect pay a lot less interest over the life of the loan. Now be sure to keep watching because I'm going to start combining a few of these tactics to really see what the value could look like for yourself. Over here we've got extra repayments. So as I said, if you went in and said, I'm going to make some extra repayments, and it might be $100 here, $200 there, I'm saying commit to it. I'm saying if you have savings that you're making every month, and say you save as a household $800 a month, then maybe you look at allocating $500 towards debt. Because if that's something that keeps you up at night, your savings ain't gonna help. Yes, it's good to have an emergency fund, which is why you're not putting all 800, but you might decide I'm gonna put in a larger portion, like $500 a month, and then we can see what the difference looks like. So again, same example, $750,000, 30-year loan term, and 6% interest rate. You're paying this off monthly, and your extra repayments monthly is about $500. So your current repayment would have been $4,496, like the previous example, but now it's updated by $500, so almost $5,000 a month. Now, the interest savings that you would have over that period of time would be $227,936, and you would save about 6 years of the life of your loan. So if you're someone that's 40 and you want to retire at 65, then you want to go, how do I pay off my 30-year mortgage in 25 years? And a quick fire way to do that would just be to allocate an extra amount towards that monthly repayment. And I think you can see where the flow on from here is how do we go and make more frequent payments with the additional payments and see what the actual effect of that looks like. So when you go ahead and combine it, we've changed changed from a monthly repayment to a fortnightly repayment frequency. And we've still kept the 500 a month, but in this case, because we're doing fortnightly payments, we've just halved that to 250 a fortnight. And what this means is that your fortnightly repayments are about 2,324, but here is the big kicker. Your interest that you're saving is about 241,564, and the time that you've saved is actually 7 years. So just by making these couple of tweaks, you can see such a massive difference. You're saving potentially anywhere between 5 and 7 years by making small changes. Now, of course, this doesn't apply to everyone. You might be in a situation where you've already got 15 years of the loan left, so the numbers will differ. But I think it's very important for you to see the actual effect of this and how it compounds over time. This is very similar to when you're actually building wealth, because when you go out and you purchase property, you're like, okay, well, I've got one, and then it suddenly does some stuff, or it's growing at 4%, which is fine, but I'm sort of getting lazy and I don't really like my job. You get to work on Monday and you're like,
Has my property gone up in value? Can I retire yet?
and that's the wrong way to approach it. What you want to do is be in the market for a longer period of time and allow that compounding gain to work out. So something you could actually sit there and do is figure out what the value of your property is today or portfolio is today, and go in with a conservative compounding growth rate of like say 5% and see what that number looks like after 30 years. And if you're not happy with it, and again, you've got to account for inflation. So although that number looks massive today, it might mean nothing in 30 years time, is if you're not happy with that, then reverse engineer it and say, okay, if I'm not happy with X amount, I need to go and put more effort in now in order for me to have more choices later in my life. Because we all know if you're watching this and you're young and you're able to go out, work, and probably work multiple jobs, you probably should. Because if you had the same opportunity now when you're 35 versus when you're 65, I'm pretty sure at 65 you're going to want to be chilling out versus at 35, when you're definitely healthier at 35 than you are at 65. Now, you might be strapped at the moment where everything that you're making is pretty much going towards your expenses. You can't actually afford to pay the extra repayment. Now, according to Philip Lowe, he doesn't really give a shit, but fortunately for you, you're here watching this channel, so you care about your finances, and I do as well. So I've actually created a video here on this channel around some side hustles you should definitely go check out. It's some quick and easy ways to actually get started, make an extra couple $100 a month, potentially every week, and it could be in line with something you actually enjoy. So it might be your side hustle that is a side business that stems from a side passion. So you're actually going, I'm looking forward to the weekend to be able to do the extra couple of hours to be able to do that. Now, I'm totally aware that not everyone's in the same position, and it's very difficult for some families. And this is why if you're in a position now where you do have time, we have so many opportunities. You've got the internet at your fingertips, whether that's creating a YouTube channel, whether that's going in and doing some Uber driving on the side. You need to know that there's opportunities out there. It's just a matter of mindset, whether you go and take those opportunities to pay down your debt and get out of this financial distress, or you wait for things to happen. As I've said on this channel, you make shit happen or shit happens to you. Now, another small but very effective method of paying down your loan quicker is actually not paying it down quicker. It's actually just having an offset account. Now, what I've got here is the same example, 750,000, 6% interest rate, 30-year loan. I've left the repayment frequency to monthly, but all I've done is I've added $20,000 into my offset account. So traditionally, when you get a loan done, you are basically saying, well, I'm going to have an offset account, or you just have a normal account. And most brokers will set you up with like an offset account because it helps you anyway, but you might have to pay a little bit extra in terms of the interest rate, depending on what loan product you actually get. I'm not actually a mortgage broker, so definitely go chat to someone who's professional in that space, because they'll be able to help you navigate through different products and different financial tools that you can actually use for yourself. But what an offset account basically is, so let's say you've got $750,000 worth of debt. You go ahead and say, well, in my savings or offset account, I've got $20,000. The bank calculates interest on the original amount minus what's in the offset account. And the logic behind it is the bank says, well, you've got the savings there. So if you really wanted to, you could go ahead and make that repayment of $20,000 towards that mortgage. So you know what? We're going to reward you by having money in there. We're only going to calculate your interest daily on the amount minus your offset account. So with that, how much of a difference does it actually make? Now here, if your monthly repayment is the exact same, $4,400, $960, the interest saved will be $93,320, and the time you've saved is 1 year and 8 months. Now it doesn't sound like a lot, but when you're at that age and you're like,
I really want to retire now.
a year and 8 months staying at a job you don't like is going to mean the world to you. And this is by simply just having $20,000 in your offset account. Again, the amount of people I've spoken to that don't understand what an offset account is, years, or even worse, got an offset account set up for them by their broker, but actually don't use it effectively, is actually quite surprising, which is why I make these videos anyway. Now that was based on a $20,000 offset balance. What happens if it's $100,000? Would that make a huge difference? Well, the same example here actually saves you interest of $362,171, and it saves you about 6 years. So you can see how a combination of having an offset account plus making the extra repayments plus increasing the frequency of your repayments can actually get you to pay down your loan much faster. And I think if you realistically have a plan in place and you execute well, you can pay off your debt in less than 10 years time, which sounds absurd because as we grew up, we saw our families, we saw our parents and people around us go,
I've got a 30-year mortgage. I'm going to be so old when I finally pay this off.
but it doesn't have to be like that. We're in 2023 and the idea is to spread this information because more people can benefit from this stuff, especially now when interest rates are so high. Other ways to actually pay off your debt faster is going to be looking at positive cash flow properties. Now, I don't want to make this a long and boring video, so definitely go check out this video. I've got some other tips around how you can pay off your mortgage faster in 2023 as well. When it comes to debt, you've got to understand that debt can be used really well for leverage gains if you were to go and build your wealth, but you would only take on more debt during a time like this when you have emergency buffers in place and you have the right strategy and team. And that's why for me personally, I'm not scared of taking on more debt to purchase more properties, to build out my portfolio, but at the same time, I'm very strategic about how much debt I want to take on, why I want to take that on, and every property I buy needs to have a specific purpose in the portfolio. So you might be someone that's young and going, okay, well, you're telling me I can pay off my debt faster, that's probably what I'm going to do. But in that case, you're only left with one property that doesn't generate you any income because you're probably going to live in there and it's debt free, which yes, gives you a lot of peace of mind, but doesn't really give you the options for self-retirement, and that too at an earlier age. So if you're interested in wanting to build out a portfolio, definitely go check out this video. I'll leave a link in the description below to our website for the buyer's agency. We go and help people execute on plans. So it's not just about plans on paper, it's about how you actually execute on those. If you have enjoyed this video, smash that like button and share it with someone else that may find some of these things useful, especially because they're so simple to implement, but yet so effective. I hope you guys have enjoyed this one. Catch you guys on the next one. Thanks guys.